switch conversation, go across. We have Abneesh Roy joining us, Executive Director at Nuvama Institutional Equities. The key here that we're going to be talking to Abneesh about is with regard to the cigarette industry. Price hikes have translated, but demand has come off as a result. How negative, largely in line? What's the kind of outlook that you have, Abneesh, with regard to the latest numbers coming through? I understand 3 to 5% demand impact in March as a result of the pricing increase. What does this mean largely? And in terms of your estimates, how much was it?
Sure. Good morning. Thanks for having me.
Great.
Yes, we will be more positive within the consumer sector, within staples space on Nestle, Marico, Tata Consumer, etc. Coming to cigarette and ITC, yes, clearly in Q4, it was a tale of two halves. January was very strong. February started coming off, and March, obviously, there was a decline. This was on expected lines because the tax hike was announced, and that obviously kicked in from February. So in January, there was a preponement of buying by the trade, and that's why January saw a big growth. But March obviously saw a decline because it was already pre-bought. Going ahead, of course, we do see that even in April, May, June quarter, the demand for cigarette will be impacted on the volumes. We obviously expect 1 or 2 more rounds of price hike to pass on the tax hike, because this time Union government took a very sharp tax hike after many years. So we have not seen this kind of a hike for many years. So obviously we do expect that almost 4 to 5% volume decline is likely, especially in the first half of FY27, because what happens in such sharp taxation, illegal cigarettes gain market share because they are not impacted by the taxation. In Q4, we expect that overall cigarette volumes, because of a strong January but a weak March, will be kind of flattish. We expect a net pricing in March quarter to be negative because the tax hike is there from February 1st, but the price pass through to the consumer happens gradually. So there will be negative pricing. Apart from that, of course, agri business for ITC will be impacted in March quarter because of the entire Hormuz Iran crisis, because clearly the container shortage, the insurance hikes are there, and overall logistics costs have gone up. So in agri business will be weak, but FMCG will be doing quite well. We expect a 10% revenue growth in the FMCG part of the business for ITC. So ITC overall, if you see, is a good defensive bet in most years. But this year, because of the very sharp taxation increase, the volumes will be negative in cigarette, and that's why profit growth also in cigarette will be negative in the first half. So it's more of a 1 year, 2 year call. Someone wants to take on ITC, good dividend yield. Next 2 years, I think tax hike in ITC, very limited possibility because already government has taken a sharp hike. It's a 1 year, 2 year call. It's not a 1 quarter, 2 quarter. That's why our preference will be Nestle, Tata Consumer, Marico in the current context, given so many volatility is there.
So Abneesh, you're saying this dip in sales is largely because of the taxation issue and not a structural demand issue, right?
Absolutely. If you see, even in December quarter, when there was no tax hike, we saw 7% volume growth in cigarette. So cigarette industry last 1 year before this March quarter has done really well. In fact, it was beating most staples growth, and that was because government had a very rational tax policy. Rational tax policy works to the advantage of the cigarette industry because then the smuggled cigarette lose market share. So yes, this is not at all a demand destruction. Basically, market share has moved from legal cigarettes to illegal cigarette because consumer is not able to absorb so much of inflation in the legal cigarette pricing.
So you're saying move away from ITC and even Godfrey Phillips or VST Tillers, the entire tobacco listed segment?
See, we cover ITC, so I'll be able to comment on that. But yes, the tax hike impacts everyone. So everyone will see a slowdown versus earlier. ITC is 75% market share, so they will have their own overall numbers, which are different from smaller players. But clearly, entire industry, legal industry will see a challenging time in terms of volumes next 2 quarters. The good part is is that from a 2 years perspective, my sense is tax hike by the union government. I think the possibility is very remote, given they have taken hike at a one go. But that's a 1 year, 2 year call on cigarette industry you'll have to take. But we feel that ITC clearly is the bellwether of the sector, and there clearly we expect the volume decline to continue even in first half, around 4 to 5% volume decline likely. Rest of the players are smaller and they will have their own numbers.
Abneesh, from a valuation re-rating standpoint, is the worst over for ITC, in your opinion?
Yeah, worst is absolutely over because clearly this is a defensive company and the dividend yield is good. FMCG is doing well. The cigarette tobacco raw material cost, if you see, that is favorable for the next 1 year because it had turned inflationary for the last 1 year. FY26 was challenging. But FY27, at least from a raw material perspective in tobacco, that is going down. So that's a positive. So overall, if I see the stock has already corrected from around 400 plus level to now around 300 levels. So yes, there is a comfort in valuation, but ultimately for any stock to re-rate, given growth will be impacted in their core business of cigarette, the trigger will be coming after 2 quarters. After 2 quarters, what will happen is clearly the entire pricing will be passed through to the end customer in terms of taxation impact. Entire pass through will happen. It doesn't happen in Q4. In Q1, it will be done, and you will see essentially that the pushback from consumers, etc., second half will be lower, and definitely ITC will also look at how to overcome the smuggling issue. The FMCG continues to do well. Even agri, my sense is when the Hormuz and the Iran crisis goes away, I think it will come back. But obviously, Q1, there will be a severe impact on the agri business. Even in Q4, it will be an impact. So yes, stock is comfortable valuation. But trigger as of now is essentially in second half, and one will have to take a 1 year to 2 year call. Dividend yield and defensive bet. But defensive bet, if you see, this year is a harsh year. In a harsh year, defensive bet is not there because obviously if the cigarette volumes decline, then the operating deleverage issue is there.
And Abneesh, also curious to know this crude sensitivity and pretty much all across the board, you likely start to see spikes in costs. But in terms of the first order impact, it'll be to the paints industry. How much can it quickly absorb? How much of price hikes are you penciling in? And if this is temporary, eventually there will be a margin expansion opportunity as well. Who will be the winners there?
Yes, we expect the second scenario. We do see that this geopolitical issue is a temporary phase. We also see that now new suppliers of crude oil are also coming into picture, Iran, Russia, etc., which was not there in the pre-Iran crisis. So there is some silver lining there. So my sense is once this actually the Hormuz blockade actually becomes clear, then we will see that crude oil and all these costs start coming down. Already we did see last week that it did come down, but again, because of the talks failing, the crude oil is up. So this is a volatile situation, but this is a temporary situation. So that's why the second scenario is most likely, because if Asian Paint, which is obviously the dominant player, the number one player, they have taken 6 to 8% price hike. Berger, Axo, Kansai, new paint players, everyone has taken a price hike. Pidilite has also taken a hike. So yes, my sense is in the second half of FY27, we'll see this play out, that margins for paint company, adhesive companies will improve on YOY basis. But in the interim, Q1, you will see the pain for paint companies, for FMCG. Yes, you're right. From a Hormuz blockade, paint companies are impacted more because 40% of the raw material is crude linked, and there the inflation obviously is almost 50-60%. So there is a severe impact. My sense is if this crude remains at $100, in May or June month, we will see one more round of price hike by Asian Paints because 6 to 8% is not enough. That's why in Q1, my sense is we should see broadly 100 to 200 bips impact on the EBITDA margin for most consumer companies. It's a bit early, but what will happen is, yes, gross margin, the pressure will be more, but companies will cut down on advertising, companies will cut down on all discretionary cost promotions. So it is not that if the gross margin corrects by say X percentage, X bips, the EBITDA margin also corrects by that. EBITDA margin correction will be lower, and that's why we are currently expecting 100 to 200 bips EBITDA margin compression for most consumer companies in Q1 and possibly Q2. H2, we should see recovery given geopolitical issue is likely to be temporary in nature, but it will be volatile.
You did talk about, Abneesh, as to how you prefer Nestle and Tata Consumer right now. But other than, the pure staples, what about discretionary spend? And again, paints is something that you've addressed. But, your QSR, the retail formats, what's likely from them this quarterly earnings?
So in the retail, we like obviously Titan because already the update is out. Gold pricing clearly is working really well for the entire industry. So they have really reported very strong sales growth. So we like Titan. We also like Avenue Supermart because the store expansion has been exemplary in FY26 with 85 stores. So that's, I think, very strong. They opened new markets like Uttar Pradesh, etc., which obviously is the #1 population state of the country, though that's a massive market. So yes, we like V-Mart because again, growth numbers were really good. So we are selective. Coming to QSR, clearly there is a two challenges. One is, of course, the LPG gas issue obviously impacted Jubilant Foods in Q4, and that's why March month there was a decline, and that's why the overall quarter the LFL was flattish versus good growth earlier. So my sense is clearly there we'll have to be a bit cautious, careful because there the costs are going up. The delivery cost will go up post-election because there will be a hike in the petrol and diesel charges. So that impacts all consumer companies. The packaging cost will also go up, and so we have to be selective. So currently we'll prefer in retail space Titan, D-Mart, Avenue Supermart, and basically V-Mart. So we are a bit underweight on QSR because there's a competition there also. Plus there is a inflation risk for the company, plus the inflation risk for the consumption. So consumer will see the pinch because if petrol goes up, I think the entire economy sees an inflation risk. So there is a price hike coming in, FMCG price hike coming in every part of the economy. So we will have to be a bit careful there because there is a lot of option for the consumer in the QSR space also. It's a more fragmented market.
Oh, yeah, absolutely. And within the listed entities, that's the pool which is likely to get hit because of rising inflation. But Abneesh, great to have you today on the show. A good color we got on the entire consumption space.
Thank you.
Okay, let's take a